In this video, you'll learn what volume confirmation is and why it's the foundation of any successful trading strategy. We'll discuss the logical elements that can be built from this concept and how they can change your life forever. For those who are new to trading and don't fully understand the meaning of this profession, I want to clarify one very important thing right away. Our primary task as traders is to identify a high-probability market scenario and try to monetize it using various tools. Nothing more is required of us to make money. Depending on the strategy, this process varies, but the core principle remains the same. It's about validating or invalidating the idea. The question arises, what is this and how do you work with it? Let's imagine that a bullish zone of interest has formed on the chart, and we assume that upon testing this zone, the price may reverse and move in the opposite direction. This gives us an idea about the market's future movement. At this point, we don't know if the reversal will actually happen. The price could break through this zone and continue its movement, which would lead to the invalidation of our initial idea. To make further decisions, it's necessary to validate the idea. In other words, wait for a confirming signal that the price is ready to move in the opposite direction. This is what we will discuss in detail now, because it is arguably the most important part of this video. In our strategy, regardless of the circumstances, the primary focus is on validating the idea through obtaining volume confirmation. This function can only be performed by an order block, rejection block, or fair value gap. These variables allow us to see how volume affects price within the zone of interest and confirm that other market participants are also showing interest in this zone. Consequently, this validates our initial idea of a reversal. In fact, they serve as a graphical representation of the impact of volume on price at a specific moment in time. That's why we refer to them as volume tools or volume confirmation. Zones of interest, in turn, are divided into two types: liquidity zones and inefficiency zones. It's important to understand that the same variables can describe both the type of zone and its function. For example, a fractal low or high belongs to a liquidity zone, but can also serve as an inducement function. I'll explain why later. Similarly, order blocks, rejection blocks, and fair value gaps belong to inefficiency zones, but have the function of volume confirmation. This is because they directly indicate areas where significant volumes come into play, making them crucial for confirming our ideas. Now, if we consider the zone of interest as variable 1 and volume confirmation as variable 2, the question arises, on which time frames should we observe them? The answer is somewhat subjective and depends on the time frames you personally trade. However, there is a proven template that optimally suits this task: weekly, daily, 4-hour, 1-hour, 15-minute, and 5-minute time frames. The rule is very simple and goes as follows. Variable 1 should be greater than or equal to variable 2. This means that if the zone of interest is on the 4-hour time frame, then volume confirmation should also be on the 4-hour time frame, or a lower one, specifically the 1-hour time frame. In practice, we usually shift down by one time frame. As for the invalidation of an idea, these are the points on the chart where, if the price reaches them, our initial idea becomes irrelevant and loses its validity. This is an important aspect because in such cases, we either need to reassess our expectations or look for new opportunities. We'll discuss this in more detail later. The first and most basic logical element that embodies all the information discussed above is variable 1 volume confirmation greater than variable 2 volume confirmation. When a zone, such as an order block, rejection block, or fair value gap, is already formed on the chart, it essentially confirms that volume entered the market for buying or selling at a specific time and price level. Therefore, we can mark this as V1 volume confirmation. For simplicity, we will only consider a bullish scenario, but know that the same logic applies in the opposite direction as well. This now becomes our zone of interest, and we need to either validate or invalidate it to make further trading decisions. As discussed earlier, this is done through the volume confirmation function. In other words, we need to wait for a test and receive one or more variables that confirm volume, but this time on a lower time frame. This will be our V2 volume confirmation. One might wonder why we look for confirmation on a lower time frame rather than on the same time frame, especially since the rules don't forbid it. The answer is actually quite simple. It's all about waiting time. For example, if your initial zone is on the 4-hour time frame, even the simplest tool, like a rejection block formed by 2 candles, would require you to wait 8 hours instead of just 2 if you were observing the 1-hour time frame. As for invalidating these zones, we need to determine a critical line where our idea loses its relevance. In both cases, this refers to the lower boundary. If the price drops even a point below it, our zones become invalid. However, this only applies when the zone is an order block or rejection block. If the zone of interest is a fair value gap, let's say on the 4-hour time frame, it's crucial to ensure that volume confirmation on the 1-hour time frame doesn't form outside the fair value gap. However, the price may close below the lower boundary. This is where the main challenge lies. On the same time frame, the price cannot close below, but on a smaller time frame, it can. Therefore, it's important to pay attention to the timing of candle closures. I think this is clear. The first example from real charts looks as follows. On the 4-hour time frame, there's an order block zone indicating that selling volume has entered the market. To ensure that the price is ready to move downward after testing this zone, we need to obtain volume confirmation. On the 1-hour time frame, the price first forms a rejection block, but the likelihood of it being tested is low. The second variable is the fair value gap zone, from which the movement is likely to continue. This is exactly what we observe. In the second example, the zone of interest is on the daily time frame in the form of a rejection block. We switch to the 4-hour time frame and see that the price smoothly tests this zone, then forms another rejection block, confirming the volume and strength of the zone of interest. After another test, the price impulsively moves upward. The third example happened not too long ago. In the context of a downtrend, the price formed a fair value gap zone, from which we can potentially expect the movement to continue. On the 4-hour time frame, volume confirmation occurs in the form of an order block zone, from which the price reacts again and continues to move downward. A similar example, a daily bearish fair value gap zone. The 4-hour volume confirmation is in the form of an order block. After a deep test, the movement continues. The second logical element is variable 1 inducement, greater than variable 2 volume confirmation. Here, the first thing we need is a fractal low or high. If the price makes a liquidity raid and then forms a volume confirmation on a lower time frame, such as an order block, rejection block, or fair value gap, the fractal will be considered valid because it was able to provide volume to the market. This is the essence of inducement. Theoretically, any fractal can be considered inducement, but we only know this in hindsight when the price forms a volume confirmation. When the price doesn't react and doesn't confirm the volume within the fractal, it doesn't fulfill the inducement function and is considered invalidated. This can be easily determined by observing the formation of our variables. For example, if the upper boundary of the order block or fair value gap forms below the fractal, we cannot consider this as volume confirmation. However, a rejection block can form below the fractal, but pay attention to ensure that the second candle closes above the fractal low. Let's now look at 3 real examples. On the daily time frame, there's a fractal low that could potentially serve as inducement for us. To confirm this, we need to wait for a liquidity raid and volume confirmation on a lower time frame. Switching to the 4-hour chart, we see that there is an area of equal lows. After the liquidity raid, the price forms a rejection block, confirming that buying volume has entered the market. The next candle tests this area, and the price moves further upward. In the second example, there's already a 4-hour fractal high. On the 1-hour chart, the price makes a liquidity raid, after which it confirms the volume with an order block and fair value gap. These zones are tested multiple times, the FVG zone is filled, and the price moves downward in the intended direction. The third example is also quite interesting. On the daily time frame, a fractal low forms. The next candle immediately takes out this low, leading to an impulsive absorption and upward movement. On the 4-hour chart, what stands out is a broad fair value gap and 3 order block zones. After the test, the price gains buying volume and moves upward. These 2 logical elements can already be considered a complete trading strategy because they encompass the basic market mechanics. If we take the zone of interest as V1, volume confirmation as V2 on a lower time frame, and target V3 on the same time frame as V1, we achieve a win rate of 53% to 60% based on my personal analysis. And that's without considering any additional context. This alone can be profitable and allow you to make money as a trader. We'll discuss this in another video. But I'm curious to hear your thoughts on how to improve entries using these logical elements. Share your ideas in the comments below. For the sake of comparison, let's examine how the principle of validating or invalidating an idea works when analyzing the market using structure. Market structure alone doesn't provide enough information for a complete understanding of market context. The basic mechanics involve the idea that, in an uptrend, highs are being taken out without lows being broken, indicating buyer strength. In a downtrend, lows are being taken out without highs being broken, indicating seller strength. The key concept here is the break of structure, which serves as the primary indicator of a trend change and a tool for validating an idea. Let's imagine we have a zone of interest where we expect a reversal. The price gradually forms a downward structure and tests this zone, then reacts and closes above the previous high. At this point, the idea of a reversal is considered validated because we've observed a break of structure. The basic logic here is quite similar to volume confirmation, but there are a few significant drawbacks to this approach that can diminish our market advantage. In my opinion, the first and most significant drawback is the absence of, or distant location of, the structure point. It's often observed that price impulsively tests a liquidity or inefficiency zone without forming any structure point in the context of the zone of interest. The closest structure point might be at the beginning of the movement, which means that validating an idea using structure can sometimes take a considerable amount of time. Meanwhile, the price could confirm volume first by forming a rejection block and then an order block, or fair value gap, within which trading decisions and positions can be made. Here's a real chart example that supports my point. The price makes a liquidity raid on the 4-hour timeframe. If we want to confirm the idea that this fractal can actually reverse the price, we need to move to a lower timeframe and wait for a break of structure. On the 1-hour chart, the nearest structure point is here because we are in a downtrend. High, low, lower high, lower low, lower high, lower low, followed by a break of structure with the formation of a new high and low. At this point, we can say that our idea has been validated using basic market structure. But note that during this same period, as many as 6 volume confirmations formed within this range. The second drawback of this approach is the requirement for the candle body to close above the previous high, or below the previous low. As a result, sometimes the candle body might close within a rejection block that forms the structure point, and we need to wait for another candle to get confirmation in the form of a break of structure. When this happens, there's almost a 100% chance that an order block zone has already formed on the chart, which definitely gives us an advantage. Here are a few more examples from real charts. A lot of effort and time went into creating this video, so if you found it useful and informative, don't forget to like, subscribe to the channel, and leave a comment.